and panelists for such a great session. The importance of enhancing institutional investment and adding new products and schemes to our capital markets has been highlighted several times during this conference. It's time we talk about it in detail. I would like to welcome to the stage Mrs. Vanessa Abernethy, partner Baker Botts, who will moderate this session, and the speakers, Mr. Munzer Barakat, Senior Studies and Research Advisor, Securities and Commodities Authority, Mr. Joshan Biederman, Head of Business Development at the International Securities Consultants, and Mr. Michel Grefferty, President, Gulf Bond and Sukuk Association.
Good afternoon, everybody. My name's Vanessa Abernethy. Thank you very much for the kind introductions. I'm a partner at the American law firm Baker & Botts, and have been in the region working in Dubai for 10 years, do a lot of work with the regulators in the region and a lot of work in the capital markets, IPOs, listing people, and also structuring funds and some of the products we're going to talk about today. So the title of the session today really is Collective Investment Schemes and Fixed Income Products. And we're going to talk a bit more broadly about not only collective investment schemes, but some of the exchange-traded funds that we see here and in other parts of the world, and then and bonds, but also some of the other fixed income products. So I think you'll find it an interesting session, but I'm aware that it's us standing between you and lunch, so we're going to keep it quite snappy today. I am very lucky to have with me today a really esteemed panel. Over on my far left, I've got Michael Grefferty. So Michael, he founded and he leads the Gulf Bond and Sukuk Association, which is an independent industry association representing the Arabian Gulf fixed income market. The Gulf Bond and Sukuk Association is composed of the region's leading banks, law firms, issuers, rating agencies, and service providers, and it plays a leading role on all major matters concerning development of the bond markets in the region. Prior to founding the Gulf Bond and Sukuk Association, Michael served as advisor for the US Treasury on sovereign debt and bond markets, where he advised over 40 countries and regional organizations. And he's also consulted extensively for the International Monetary Funds and the Arab Monetary Fund. He has degrees from New York University and Georgetown University in public finance and international relations. Welcome, Michael. Then we have sitting next to Michael, Jochen Biederman. He's in charge of business development for the Hong Kong-based capital markets consulting firm, International Securities Consultancy. International Securities Consultancy is one of the world's leading professional capital market consultancies. It specializes in providing advice and technical assistance to governments, stock and derivative exchanges, regulators, central depositories, clearing companies, and multinational financial organizations on all facets of establishing and developing capital markets. Before joining the International Securities Consultancy, Jochen worked for 15 years in different leading positions for the Deutsche Börse Group. From 2010 to 2013, he was responsible for International Affairs Unit, leading a multinational team in charge of business development and sales activities in Russia, CIS, Central and Eastern Europe, Turkey, MENA, and India. So welcome, Jochen.
Thanks a lot.
And then I'm lucky to have on my immediate left, Dr. Munzer Barakat, who's a senior advisor with the Emirates Securities and Commodities Authority, so he will be providing the regulatory piece for us today. He's head of research and financial analysis, and he has a very high-powered education background. He's earned a PhD in finance from the Oklahoma State University, an MBA with a concentration in finance from the Annaja National University, and a bachelor's in mechanical engineering from the San Francisco State University in the US. He's a chartered financial analyst and a member of the CFA Institute. He's a certified financial risk manager. Dr. Munzer is currently involved in the technical aspects of writing financial regulations, market mechanisms, including products and financial services, IPO valuation, listed company analysis, investment funds licensing, and authoring referred financial research. And I was really interested to read that he's published a book, but that's something you might want to talk to him about over lunch. But welcome, Dr. Munzer. So I'm going to run this session in a very interactive way today, and I'm very happy to take questions from the audience at any point as we progress, provided they're relevant questions. Please, I'd rather they were questions and not comments from the audience so that we can get the panel that we have here doing most of the talking. So feel free to put your hand up as we go along. I'm not just going to wait till the end for you to take your questions. But one of the things I've found most interesting on my 10 years in working in this region is I regularly get asked questions from foreign financial institutions that are used to working in the more developed markets that want to bring some of the more sophisticated ETF products, fixed income products and funds products to this part of the world and ask me my views on those products coming here. And one of the things I've observed is that it's, from a regulatory perspective, it's slightly problematic. It's not quite as straightforward to bring those products here, list them on the market and have them trade as it normally would be. But also from an investor awareness perspective, perhaps some aspects of the market are not ready for those products. So I think it would be really interesting to focus on some of those things in the session today, but I'd also like to hear from the panel as to what they think the main sort of concerns and benefits of the current market are. Michael, would you like to start?
Sure. Thank you, Vanessa, for the kind introduction. And so I'd just like to say that we're delighted as an organization to work with many of the regulators in the room in the Gulf and more outside of the Gulf in North Africa and Levant as well. We're also delighted to work along closely with our international partners like our Monetary Fund and the IMF, as we're all looking to develop these critical fixed income markets in the Arab world. But we also work closely with, and this has been referred to, I think, repeatedly yesterday, in addition to the regulators, with the central banks and the fiscal authorities, all of whom are really critical to being around the table for developing these markets. We promote market practice and create awareness and extensively work with the regulators like the Securities and Commodities Authority. We also very deeply believe in and support regional harmonization and integration. As a practical matter, I have to say, though, that we spend most of our time over the last years working on the national level because that's where the regulation is at this time. So we have a longer-term view towards harmonization and regulation. And I think sometimes we're, to the extent that we're providing the similar kind of advice across borders, when the integration process happens, when there's that will, hopefully they will have already arrived at some, at a higher level and having reached many of the same conclusions. We see a lot of issues in the MENA debt markets towards developing the MENA debt markets, but I think they boil down to, well, two: supply and demand. And I think we'll talk a little bit on the panel about institutional investors and particularly about investment funds, which is quite critical. And then as well, I think I'd like to talk about a little more about improving the value proposition of the bond markets for potential issuers who have not tapped the markets yet, who may be family businesses and the like, who represent the real economy.
That's great. Thanks, Michael. I'm sure we'll go in more depth into that as we go along. Jochen, what's your view on the market and the issues?
Ladies and gentlemen, maybe also on behalf of the other panelists, let me thank Jalil and his team and also Thomson Reuters for this conference. I hope to be here again in 9 years for the 10th one, hopefully. Let me comment a little bit on ETFs. So working here with some of the capital markets, obviously there are a lot of very important topics like family-owned business, SMEs and so on, which has been touched. But one thing strikes me a little bit, coming from Western Europe, but also being headquarters now in Asia. I'm aware of so many exchange-traded funds being offered to retail and as well as to professional investors. Alone for the company I was before, Deutsche Börse, the exchange in Frankfurt, there are something like 1,200 ETFs offered, let alone, I think, ETFs. There are also exchange-traded commodities and other derived products out of this, which are heavily traded among retail and as well as institutional investors. In fact, some of the ETFs on the blue chip index, they're even more liquid than the most liquid stocks there. So we're talking about liquidity costs of 4 or 5 base points. However, here in this region, we have something like 4 ETFs, 3 in Saudi, 1 in Abu Dhabi, which are not so much traded. And so it strikes me what is the reason for this and why such a very attractive product, which is easy, understandable, very cost efficient, isn't used more in this region.
Thank you, Jochen. Dr. Muntha, from ESCA's point of view, why don't you tell us a little bit about the current place in the market?
Great. ESCA, as all regulators, we have a very clear strategy on where we're going and what we want to accomplish. in this strategy, we're trying to develop our securities markets to make them conducive and attractive for local and international investing. As you know, lately, the MSCI and other index providers around the world have upgraded the UAE markets from frontier into emerging. And also, we have a roadmap to go from emerging into developed within the coming few years. In this strategy, we try to come up with state-of-the-art regulations. Those regulations adhere to or go along with best international practices and what investors in other jurisdictions are used to. We're trying to offer them enough products, enough mechanisms, enough securities, and supervision system that covers all of that for investors to be comfortable to come to the UAE and invest their funds. Today we will be talking about a couple of regulations that ISK had worked on and is still working on. The bonds regulations, bond and sukuk regulations. We've recently amended those regulations and made major changes to the existing regulations. We are also proposing a few regulations for the funds and the collective investment schemes. I would like to share those with you along when we're talking to hear what the industry would think about these proposed regulations.
And thanks, I'm very interested in hearing about that as we progress. Just before we turn it over to the audience to see if we've got any questions, I'd like you all to locate, please, your voting button machines. I'm going to do things a little bit differently, technology willing. What I'd like to do is pose 3 questions to you. I'll get you all to vote, but we won't talk about the answers immediately. I propose to discuss those in a bit more detail with the panel later. So can we have the first question up, please? Do you think investors in the MENA region have an appetite for sophisticated fund and debt products, such as exchange-traded funds, REITs, index tracker products, and convertible products? So we've got 3 answers possibly up there. Yes, any products that are actively offered in the developed markets would be well received by investors here. Yes, but investors in the region are not quite ready for some of the more complex products offered in the more developed markets, but we'd like to see some expansion in the range here. Or no, this region should focus on developing more depth of investment in the range of products we already see and only look to develop the product range once the markets here are more active. So if you could all tell us your position on that, that would be great. Thank you. Thank you. Question 2. Thank you. What do you think the main impediment is to expanding the collective investment and debt product offerings in the MENA region? Is it A, lack of regulation for listed products at the exchange and regulator level? B, lack of laws to enable these products to be structured locally? C, lack of understanding of more complex products structured by investors? Or D, lack of interest by local financial institutions in structuring and offering a wider product range? Your views, please. Thank you. Question 3, this is the final one, people. How long do you think it will be before the MENA markets are seeing active trading in a full range of collective investment scheme and debt products, as is currently seen in the more developed markets? Are we looking at A, the next 2 to 5 years, B, in 5 to 7 years' time, C, in 7 to 10 years' time, or D, not in the foreseeable future? Thanks very much, everyone. So we'll address the answers and see what everyone thought a little later in the session. What I'd like to do now is turn it over to the audience if we have any questions at this stage. Otherwise, we've got plenty to talk about up here, so over to you. No? Okay. I'd like to open, yes, certainly, down the front.
Well, some of the Thank you, Anu, for the questions. They were really very well done questions, and probably the feedback will direct some of the people here to do something about those issues. The question here, unfortunately, in our region, some of our exchanges have tried the ETFs, and unfortunately, it did not take off. So, what's the reasons? If you talk about liquidity, Saudi Arabia is a very, very liquid, yet it did not achieve, a good, or it was only one fund, and probably that's it. Thank you.
Yes, and you're correct. There is an ETF currently available for trading on ADX. Perhaps, Jochen, you've got something to say about your view on that.
Ahmed, thank you for that question. So when I talk to the people here, I always hear I think the claim that the markets are not liquid enough, not enough blue chips in the local markets available, which all sounds very reasonable as a reason for the ETFs not taking up. On the other hand, from Europe, from Germany, I can trade the GCC. I can trade ETFs on GCC index. There are even many, I don't know, 5 or 6. You have the choice, ex-Saudi Arabia, with Saudi Arabia. You can easily, as a retail investor, invest your money in an ETF covering the GCC. So it is possible. Some people manage to do so. I think ETFs obviously could help and benefit in creating more liquidity for the market. Obviously, some of the markets in the GCC are more risk-seeking. Looking at the retail investors, some are more risk-averse. So the risk-seeking retail investors, they might prefer going directly into share investments. The more risk-averse, for them, ETFs, I think, is a good product because it provides diversification. You can easily invest in whole regions. And from my point of view, that should be something I think the GCC, not the individual exchanges, should strive for. Offering ETFs which are covering region. Because covering the GCC region, you have enough blue chips. I think normally you need something between 30 and 50 for good ETF. So 30 and 50 in an index for having a good ETF on top of it. I think that's manageable here in the region. So I do not buy that liquidity instrument. I buy more a question of are the investors educated? Are the brokerage houses educated on this? Do they have enough incentives? Because ETFs by nature, it's a low margin product, so maybe some of the issuers and some of the brokerage houses do not have enough incentives, I think, to come up with such a product. Because ETFs, I think, are attractive if you scale up, if you see a lot of volumes, if you have many ETFs as an issuer, then it becomes attractive. But the first one, I think you have to invest more in the infrastructure, in the creation, redemption process, and so on, and in education.
Thank you. Given that we have a really heavily retail, the liquidity tends to be retail liquidity here, and we have a lot of people with a lot of interest in equities. Michael, do you think if we had more bond products trading, we'd have similar issues with what's been observed by the gentleman in terms of perceived liquidity as we have with ETFs?
I mean, I don't think that availability of more debt products is necessarily the key at this point, and we're not really focusing on that. I think what we need is to develop liquidity is more volume above all, and a richer set of investors. We need an investor bases who have a full range of investor bases with different interests and different points of view on the market, and that's an institutional market, really. So. I'm not sure that looking at debt from a retail point of view is really the way to drive liquidity. I mean, of course we're pleased, and I would be happy for retail interest to develop in fixed income, but it's probably better through funds for the most part.
Okay, that's great. Has anyone from the audience got any follow-up questions to that line? Yes, we've got a gentleman here around the middle.
شكرا. بالرغم من وجود السيولة الكبيرة في المنطقة إلا أن كثير من الدول المنطقة تصمم ميزانياتها السنوية لسد احتياجاتها هي، احتياجات الدول، وليس لسد احتياجات الاقتصاد الكلي. فلذلك ما تحاول أن هي تستغل هذه السيولة وتضخها في الاقتصاد. ممكن التوضيح وشكرا.
I didn't have my translation on for that, but
The
Dr.
question is that governments have excess cash, and the cash is used for the government budget. Why don't this government use this cash to enter the market? Isn't that correct?
I think it's a good question. In other parts of the world, Jochen, do governments start or kickstart the liquidity or invest in these types of products?
Yeah, I think, look, for instance, at China. I think they have something like 3.5 trillion US dollar in assets, but they are promoting their bond market. I think they are at least, I think, encouraging that market to grow by, I think, issuing government bonds. I think it's a good strategy, even if you're long in cash. I think because I think it helps the market to develop.
If I may, some of the governments, especially in our area, most governments have excess cash. They do actually invest in their own markets, but the method of investing needs to stick to the disciplines of the market, meaning that if the government wants to invest, it's because they want to invest and get return, not to push the market. The market mechanisms should take care of the pricing. For instance, if the government wants to enter the market to increase demand, that wouldn't be the right way to do it. But my understanding is that governments do, through their sovereign funds, through their owned companies, they do enter the markets and they do participate.
So, Dr. Munther, are you seeing some of the stuff that ESC is doing with your investment fund regulations perhaps stimulating more ETFs onto our market?
Yes. The ETF is part of our collective investment scheme regulations. We have our funds regulations. They came out in August of 2012. We put them to test. By the time they were being prepared, we were a frontier market. Now, after we transformed into emerging market and that the institutional investing is going to increase, we are thinking that these regulations need to be amended accordingly. The first thing that our current regulations lack is a definition of a sophisticated investor. In the current regulations, we measure sophistication by the minimum size of the ticket they can buy. For instance, if the fund is privately placed and it's from another peer jurisdiction, the minimum ticket would be 500,000. If it's from a free zone, the minimum ticket would be 1 million to add sophistication to the investor. We encountered two problems with this. First, that a lot of people in the UAE and in the Middle East have these amounts and they can invest without having to be sophisticated. The second problem is that nobody can find a good definition for a free zone and a peer regulator. Cayman Island is a free zone, but they are a full member of the IOSCO. So that was another problem. Now we're thinking that we should introduce a definition for a sophisticated investor. The other two things is that for a sponsor, we used to have a very cumbersome requirements for sponsors to initiate funds, and that was because the fund industry was introduced recently. We did not have a good pass test for it. We also asked the sponsors to have 3% seed capital in the funds. Those are thought now, we're proposing to alleviate these conditions. We also are building an exemption regime and a super exemption regime. For instance, if a fund wants to establish itself to market to ADIA, for instance, or big sovereign funds, they should not have a cumbersome registration procedure. In the past, we also dictated that if a board of directors of a fund should be only 5 or 7. If it's 5, then 4 independent and 1 from either the sponsor or the investment manager, which is usually the same. If they are 7, then they can have 2 seats. We found that in international practices, usually they mandate 2 independent and no limit on the number of the board members. We also, and because of some legal restrictions in our commercial companies law, we structured the funds in our current regulations as a company that has a board of directors. And that was an impediment for a lot of people to come and register funds in the UAE. Now, after we sent our amendments to the new proposed commercial companies law that recognizes the fund as a person, we are allowing other types of structures of funds, any type of structure actually, including REITs and ETFs. The other thing is that we did not have an unwinding regime for funds. If you want to end the fund under the current regulations, you wouldn't know how to do it. One of the funds tried to unwind and we couldn't find a legal exit for it. The final thing, I don't want to take a lot of time, the final thing is promoting foreign funds. The current regime asks each fund to be registered with ISCA, even if it's promoted by more than one person. So we need to register the promoter and we need to register the fund itself. For instance, Citi wants to distribute XYZ fund, and HSBC wants to promote the same fund. Both have to come, register as promoters, and both have to register the same fund. We're proposing that the fund registration should be done by somebody, the promoter should be registered by ISCA, and they will notify us which funds they're distributing. The final thing is that we're also working on regulations for investment managers, for administrators, and other service providers to the fund. These are not existing now, so we will complete the entire collective investment scheme regulations. Thank you.
I think the market's going to welcome a lot of those changes, particularly the private placement, the loosening up of the private placement exemption. The one from a legal perspective, since I'm a lawyer, that I was particularly pleased to hear about was your changes to the structure, because the commercial companies law as it currently is, or as it was, has been an impediment. We know that funds are often structured in other parts of the world down the route of a partnership, because it's not practical for unit holders to be able to vote and control how a fund is run. That's usually done by the people who have established the fund, with the unit holders only having a financial interest. So I'll be really interested to see if we can open the floodgates a little bit and have a whole lot more of these products based here instead of in Luxembourg, Dublin, Cayman Islands going forward. You had a question, sir?
Thank you for the discussion, the comments on the bonds and sukuk especially. I don't know about collective investment schemes. I come from Saudi Arabia, and the growth in that market has been quite robust, ever since it started in the early 90s. They're not anywhere near the size they need to be for that size of economy, but I think they'll get there with time. But I think sukuk and bonds are extremely important for development in the region. And I'd like to throw out a couple of factors, I'd like to get some sense from the panel as to how important they think they are. One is the question of the Sharia position on the secondary trading in debt. Even sukuk for that matter, secondary trading in sukuk, there's quite a bit of, I think, difference of opinion, controversy surrounding that. Maybe that's one of the concerns that detract institutions and high net worth individuals from participating in that market. Second is the participation of less than quasi-government or investment grade issuers, higher yield issuers, and that may also be related to Sharia issues, as well as the question of investment banks not being active in that area. Yeah, well, actually, there was a third issue that I think that one might maybe research as well, research in the Sukuk and bond area, and perhaps I would throw out the idea of maybe having collective investment schemes in bonds and Sukuk might be something that is a way forward, because that would involve bringing in sophisticated asset managers to help to act on behalf of customers.
So, Michael, you'll probably have some observations on secondary trading of bonds and the sophistication levels of the people who are trading them.
Sure, I'll try maybe in kind of reverse order. Yeah, collective investment schemes, mutual funds, and bonds and Sukuk fit beautifully together. So this is why we take so much keen interest in what the ESCA has done and is looking at doing. And we think that should have, if some of those things go forward, it should have a great halo effect on the rest of the region. And it would be a great shot in the arm for both the bond and the Sukuk market. I mean, we do have, even locally, bond and Sukuk funds. And frankly, the Sukuk funds that have been opened haven't collected that, they have not been that successful in terms of assets under management for whatever reason. There's of course a shortage of product available. It's difficult, investors in the region have difficulty getting hold of Sukuk, even issued by an issuer who may be located across the street because it may be held elsewhere. There are issues. I mean, a lot of those issues, though, I'd say have to do with regulatory issues that affect all funds, things like concentration limits, for example. When you have a very small market, a small local market, you may not want to apply the same concentration limits on individual funds in terms of their holding. If you have only 5 bonds that are available, there may be other ways of protecting the investors, let's say. Otherwise, the funds will simply just have to close if there isn't enough flexibility in the regulation. You mentioned the high yield sector. I think this is something that is healthy, and I think we should never use the junk expression or term, because high yield is something that is very, very valuable, and I think it's actually the future of issuance in the region. I mean, for the classic issuers in the region have been sort of state-related, high quality, semi, either implicitly or explicitly guaranteed by the state, and that's not a particularly helpful, beyond a certain point, approach. So the real economy is full of good, unknown, lesser-known potential issuers who need to get their stories told, need to get rated, and those ratings may not be in the AA category. They may not even be investment grade, but there should be a market for them, and I think that's why it's gratifying to see the shift among the regulators from a kind of what we call a merit-based system for approval to disclosure-based. Again, we trust the investors, given the high quality of disclosure and liability for those who produce the disclosure, that then they will be able to make their own decisions and then find a risk-reward place where they're comfortable. So let's keep an eye on that space. In terms of trading of Sukuk, in particular, there are lots of challenges. All bond markets now have special challenges, not just in the region, in emerging markets, and at least as much in developed markets. And I think, as you pointed out, certain Sukuk are actually prohibited. I mean, are not eligible for trading. And I think some of that, one piece of advice I would give would be for the governments and central banks which issue Sukuk, and we wish there were more, the ones that do, to issue them in a tradable format and to make that clear. Because without that format and without that being clear, then the idea of a secondary market developing won't get off the ground.
Michael, if I may add to the question of high-yield corporate bonds in Europe, we have made quite good experience over the last years with it, in particular for financing small and medium-sized enterprises. It's also a step, I think, towards using more the capital market, towards getting used to more transparency, which might end up then with an IPO at a later stage. However, there's a small downside. You need to be careful about educating the retail investors that there is a risk behind. So even if they are offered a bond with a nice coupon, this certain company, even if it has a long standing for many years, it can fail. And there were few failures, few insolvencies in continental Europe. So, and some retail investors were hurt. They thought, okay, it's nice here, it's a place where I get a decent interest, which I won't get from the banks anymore in the European Union environment, but they need to be aware of the risk.
If I may, I'd like to say a word on the Sharia thing. We at ISCA, when we first started drafting our Sukuk regulations, we started thinking, should we put some standards for what's acceptable in Sharia and what's not? And then should we accredit the Sharia boards? And once we talked to the industry and we talked to other regulators and other regulators in the country, we found out that the optimal way to deal with Sharia is to leave the Sharia decision to the industry. How we did this, we said any issuer, any obligor who would assign a credible Sharia board, and credible is up to them, who says that this sukuk or this instrument complies with the principles of Sharia, of Islamic jurisprudence, is acceptable to us. Now, how credible these people are, or how credible their fatwa is, should be factored in the risk premium and the pricing of the sukuk. So ISCA, when you read our sukuk regulations and even the funds regulations, we're saying an obligor should, or the sponsor of the fund should hire a Sharia board. The Sharia board should write in the prospectus that this product is compliant with the Sharia principles. If it comes to us, we will approve it. The second thing, what's the meaning of sukuk? We studied the matter with a lot of scholars, with a lot of practitioners. We did not find a consensus on the definition of a sukuk. Is a sukuk a debt instrument or a temporary equity instrument on a certain fund, on a certain asset? If it is an equity, a temporary equity on a certain asset that could lose when the asset loses or depreciates in value, or should this asset stay on the balance sheet of the obligor, or should it go out on a balance sheet of an SPV, and the SPV would issue the sukuk, take the cash and give it back to the original owner of the sukuk? And how does it go back when the sukuks are redeemed? All of these were a great lesson for us as a regulator, and other regulators may benefit from this long debate around the issue, is to leave the Sharia for as a commercial decision for the issuer of the security to determine how to determine how, if it is Sharia compliant or not, and for the investor to incorporate in the pricing of that instrument, depending on the credibility of who's saying it's Sharia compliant or not. Thank you.
And I applaud ISCA for that approach, because I think the job of any regulator should not be to merit regulate an investment, but to provide the regulatory framework by which the market can make their own assessment and price accordingly across any product. So I think that's the best view. You're not leave the Sharia stuff to the Sharia experts and focus on how we regulate, regulate what does come to market, but not merit regulate. We do have a few more questions from the audience, but I would just, if our technology guys are ready, it might be a good time to call up the answer to question number two, because I'd be quite interested in finding out, we've been talking a bit about some of the impediments we're finding in the market. So I'd be quite interested in finding out what the audience's view was initially about what the main impediments were to these markets being kick-started here. So we seem to have reasonably overwhelming preference for answer C. So C was a lack of understanding of the more complex products. So it seems that on that basis, actually I was quite interested that that A features quite low, because I find as a lawyer, A is one of the ones that occurs to me as being an impediment, and obviously ISCA is working quite hard to make things better, certainly in this country. But C, lack of understanding. So that would suggest we need to do something on the investor awareness side of things, guys. What do you think?
It's part of our mandate at ISCA to deliver awareness sessions. In our regulatory process, we first start looking at international practices, and then we will consult with some leading firm like yourselves in the industry to help us draft the regulations. And then we start doing workshops to explain the regulations to the investors, explain them to the institutions, get feedback from the industry. And once the regulations are done, said and done and are out, we also do a program, a series of awareness sessions on that regulation. For instance, when the funds regulations came out, we did 8 sessions of awareness to brokers, to financial analysts, to institutions, and to the mass investors. Even we visited universities to explain what an ETF is and why or who should invest in ETFs. The problem is still that the majority of the traders, the latest figures from both stock markets show that 75% of the traded value comes from retail. 35% of the ownership is also to retail. This is sizable in any market. Look at Frankfurt Exchange, 99.99% of the trading is by institutions. When the institution trades, they have better understanding. We always tell investors, there are complex instruments on the market. To be able to trade in them, you need to devote a great deal of time to understand them, to learn them. You have your job, you have your life. You as investor are not required to study the entire finance industry to be able to invest. Put your money with somebody who knows. Benefit from their experience. Benefit from their risk-based methodology of investing. The other thing is that not all, some of the institutions who invest in these instruments also don't have enough personnel devoted to teach the investors about these instruments. A brokerage firm should have a person or two, or an investment firm, to tell their clients what an ETF is, how it works, why is it good for you or not good for you. Then the investing starts kicking up. To move the markets from emerging into developed on the scale of index providers, we need to introduce even more complex products. Need to get into futures, options, swaps, GDRs, REITs, rights issues, warrants, covered warrants, convertible bonds. This is a lot for any retail investor to understand. It's a lot for many small brokerage and small institutions. So we need the industry to invest with ISCA, with the regulators, in educating the mass public, in mass investing public in these instruments.
And Jochen, do you think that was a good observation that there is a general lack of understanding of these products here?
I think, first of all, in investor education, I think it's a must in every market. You need to start in schools, universities, and so on. I think that's worthless to mention explicitly. I think this has to be done. When it comes to the products like ETFs, those products aren't incredibly complex, right? So an ETF in the way it's created, it's a little bit complicated. But in the way I handle it as an investor, it tracks an index. I always look at the index value, and I know where my ETF stands. So it's, from an investor point of view, rather easy. And it's safe, it's like a fund, it's segregated assets. So from an investor point of view, there's not much to understand here. If I know about an index of a market or of a region, I know about my ETF. Some bonds even are more complicated than ETFs, it's my take. But you've rightly said, there are obviously much more complex products. So from Germany, where I originate from, we have something like 1.2 million structured products, which comes with a lot of different flavors and different conditions. So this is much more complex, but even this is understood by retail investors because they're educated by their brokers. They go to seminars from their brokers and they make use of these products, for instance, to hedge their mortgage or for other things. I think to hedge their energy bills. So even there, I think they can make use in a nice way of those products. But ETF and bonds, I think that's basic.
Just
One final comment, I'm sorry. I'm not talking about myself as a person. If I am not educated in the field of finance or financial instruments, and I go as a retail investor, invest in the market, and I know on the other end of the deal, there is this sophisticated trader. Who do you think is going to win end of the day? It's really hard for somebody like me who has little knowledge to win against those big institutions who have specialized people. So the old wisdom says, if you cannot beat them, join them.
Yeah.
Invest your money with them. They can make you some dough.
Invest in an index.
Yeah.
Then you join them.
Did you want to make a
Yeah,
quick comment?
Yes,
Then we'll go to the
personally,
question in a
I
minute.
had to suffer a little bit before I learned that lesson. But, and then as well, just a last word on investor education. I mean, the regulators themselves don't have to do it all, and nor are individual brokerage firms capable probably of really providing education. I mean, there's a certain obligation, but as well, regulators can task, in a sense, their market organizations, and not to volunteer for work, but that's the kind of thing that market organizations do, as well as representing the industry. Also, I think, have a responsibility towards reaching out and educating.
That's great. Now, we had a question in the center of the room here.
Thank you, ma'am. My name is Ali Zbib. I'm a lawyer and university instructor. Mainly my question is for Mr. Michael. However, in the context of what Mr. Baraka just mentioned, we always have a problem with the credibility of the Islamic Sharia board. Not in general, but what you mentioned, that who identifies what credibility is. Disregarding the Sharia compliant elements, we have a general obstacles in facing the matter of jurisprudence in the religion in general. So when they move this to Sharia Islamic boards, they have their own fights there. They have their own different opinions. And sometimes it's very sensitive because at the end of the day, you are dealing with the Sharia. So I need you, please, to clarify again what is the approach related to the credibility of the board. Excuse me. Because this is one of the main problems. I have seen examples that, I can tell you about, that certain decisions made by Sharia Islamic boards were solely dependent on trade benefits, non-Islamic compliant trade benefits. So if you want me to go through the second question and then you might answer, that would be fine.
In ESCA, our regulations do not mandate any certification for the Sharia board or any skilled knowledge. All you need to do is to get a Sharia board. Sharia board says, writes in the prospectus, this is a Sharia compliant product. What we're saying, this should be a commercial decision. If you, as an investor, do not believe in this board or in its credibility, you will shy away from the product. Demand goes down, price goes down, required rate of return goes up, and it's not going to be feasible for the issuer to issue this security unless they come up with somebody credible. See, we left it for the industry to compete to get the best out there to get the fatwa.
Sir, but the
regulator,
investor...
there are so many schools of thought. The regulator, if we get into this, it's going to be a mess. Regulator should not mandate a certain school of thought, should not mandate a certain accreditation or qualification. Some people think if you get a high school from certain area institution would be much better than a PhD in another institution. I don't think
it's
this
subjective.
Our
I believe
stand on
you.
this.
So the problem is ongoing. It will not be solved because you just said that the investor does not have to know everything.
I don't think there's a solution to it.
Exactly.
I think we have to put the responsibility, not just on this, but for a lot of things in this part of the world, onto the investor, because that way we're going to raise the levels. People need to take an active interest and responsibility in understanding what it is that they're investing in. And if you allow the regulator to get very involved, they're not forced to do that. Whereas if the regulator says, you need to take responsibility for that investor, then people are forced to gain that awareness.
That's what the scholars keep saying, scholars who work in finance, that it's one of the features of the Islamic finance is that you cannot mandate one thing on all the people. It's left for people to arbitrate, to think, and come up with their own interpretation of things. That's what they say.
I mean, I don't think that we're in a position now for different reasons. I mean, I think the idea of a national Sharia board has a lot of merit to it, but I don't think we're in a position now to take where there's a level of consensus as there was in Malaysia to adopt such a kind of state-directed program. So in the meantime, or short of that, I think, though, it should be directed from the investor side. The investors can come together if they like and direct. I mean, if they don't buy, if they vote with their feet on certain structures or certain ways that the fatwa are developed and so on, that would get their attention. The other side would be for the scholars themselves to develop a kind of corporate governance amongst themselves, and there have been some discussions in that respect, which would address things like potential conflicts of interest and sitting on multiple boards and so on, and other actions that may follow related to best practice.
Now we're running up against some time issues.
Actually, my main question was for Mr. Michael. If I may, just 30 seconds, if I may, ma'am.
Sure.
Right. Not related to the Sharia boards, because I know if we debate this for 10 hours, the answer will be the same and there's no solution, so I'm just going to stop there. You mentioned the maturity of the market. I know that the market in the Gulf, the bond market, the sukuk market is getting more mature now. But I do know that we still lack the element, the legislative and the regulatory perspective. And I need your intake briefly regarding that. And I also need your view regarding the gold sukuk and the green sukuk. Is the market mature enough to start, and I know it has started already, but the issuance of gold sukuk and green sukuk, please. Thank you.
Sure. I mean, I think when we talk about the Gulf bond market or bond sukuk market, it's really it's two stories. I mean, it's an international market. It's basically issuers from the Gulf issuing into international markets, and then those securities are then bought and held internationally by institutions and so on in other financial centers. Some of them are repatriated to the region, but the rules and regulations, by and large, aren't delivered by the regulators here. So they're in dollars generally. They're euro clearable if they're not issued in the Malaysian market, for example. So in terms of a local market, in terms of what we would really like to develop over the medium and long term is the local market, which is then supported by local regulation, maybe in local currency, maybe more readily available to local investors, markets made locally. So those markets, frankly, are still in infancy. Saudi is an exception. It has some volume. It has some investor base. So the internet, you have very sophisticated issuers in the Gulf who understand, among them banks and so on, but they're not using local regulation. So we're kind of in a little bit of both. And I'm sorry, the second.
It's about the gold sukuk and the green sukuk and the readiness for the market to take those two.
I mean, I know that I've heard about a gold sukuk being structured. It's very interesting, and it will probably find some place. It may be not something that's going to be widely demanded, but from what I know of it, central banks may have an interest in it. But that's something that's still very, very young, and I wouldn't expect it to be more than a niche kind of instrument. As far as green sukuk, I think we may see a green bond first. I'd be happy if we see a green bond from the region first. The green bond market has really exploded by 3 or 4 times this year as opposed to last year, mostly out of Europe, some from the US. We certainly, the logic towards a double green sukuk from the region, we need all sorts of renewable energy and everything that is green in the region, and the sukuk market is perfectly suited for that. But what we don't have is a dedicated investor base, an SRI investor base in the region yet. So it's early days, but I think when we bring an issuer, as we bring more attention to it, I know that the Dubai Supreme Energy Council is looking at this, and I'm sure that there are others who would love to have a first green sukuk out there. We may see one before that in Malaysia. We'll see who's first.
I'd just like to call up the answer, if we could, to the first audience question I posed, which was, do we think investors in the MENA region have an appetite for these sophisticated type products? If you could let us know, please. The vote, which was B, pretty overwhelmingly yes, but we're not ready for some of the more complex products. I think I would probably have agreed with that we should bring a few new ones, let the market understand those and start trading those before we start introducing some of the really complex ones. Yes. Was anybody surprised by that answer, or you thought that was? Perfect. Yeah. That's about right. Okay, I'm going to wrap up. Just finally, we had a third question, which is how long do we think it's going to be before the MENA markets see active trading in a full spectrum of these types of products? If we could call up the answer to that question, because I think that's going to be a perfect place to finish. What do we all think? Well, that was fairly evenly split between B and C, 5 to 7 years, 7 to 10. So we're looking at a 5 to 10 year stretch. People are generally thinking by the time we get investor level and education levels up to speed and we continue to work on the regulation, in 5 to 10 years we're probably going to be looking at a different landscape than we've got now with a lot more of these products. So that's actually pleasing to see, because that's probably the time frame I would have been hoping for and aiming for. If we're all available here afterwards, so some of you will be really hungry, so I think we need to break now for lunch and let the Thomson Reuters guys stand up and finish things off. But all of us are going to be around. Well, I know I'm going to be sticking around for lunch. So if anyone has any questions you want to pose, particularly to us, feel free to come and talk to us afterwards. But I'd like to thank Michael, Jochen and Dr. Munther very much for your time today, and thanks very much for the intelligent questions from the audience.